In this video, we are looking at problem 711 in your book, where we're going to use the capital asset pricing model to calculate the required rate of return appropriate for the investment project. But before we do that, I want to jump really quickly back to problem 7.9 and just show you the formula that's in the green cell right here. And if we follow the cursor up, we can see the formula in the address bar, and this is the Excel version of the formula from your book right here. So for those of you that really like spreadsheets and want to learn more about how to build your own, you can sort of look at this formula and figure out what I did here to make it work like this formula right down here. For example, you have to know mathematically that if you take the square root of an expression, that's the same thing as raising it to the power right here. See if you follow my cursor. I'm right up here at the end here. The square root is the same thing as raising this whole expression to the power of 1/2. So those are the kind of things mathematically you need to know in order to build these formulas or equations into Excel. And just want to remind you, try not to delete or clear the contents of these shaded cells, because that's where your formulas are. And if you do really mess up the spreadsheet that you're working on, you can always just go back to your assignment page and download it again and just start over. Okay, let's jump back to problem 711 and just look at this. The only thing that you really need to look at here that I want you to look at here is just this idea of a beta and what happens when we change it. So if we have just a beta of 1, what that means is that our required rate of return appropriate for the investment is going to be the same as the required rate of return in the overall market, because a beta of 1 is the market. It's the same average risk as the overall market. So if that's what our beta is, then that's where we're going to be. Now, if our beta is higher than 1, and in this case in the problem, jump back to the problem, do it the right way. Okay, if it's higher than 1, what that's saying is the beta of our firm, and actually what's given in the problem is a beta of 1.2. So the problem numbers is that the beta of your firm is actually higher than the market beta, which is just saying that the returns on your firm's in investments fluctuate more or are more volatile than the market. Therefore, they're a higher risk. If your beta is lower than 1, then that means that your investments are fluctuating less than the market. They're less volatile than the market. Therefore, it's a lower than 1 and a lower a risk than the market. Now, how that plays out is that if you have a beta of lower than 1, that means that your investments are fluctuating less than the market. They're less volatile. So the required rate of return for your investment is going to need to be less than the overall return in the market. If your beta is greater than 1, that means that let me just put in 1.4. That means that your required rate of return on your investments is going to need to be greater than the market, because your firm's returns on all of its investments has shown to be more volatile. So if the expected returns are more volatile, in other words, they're harder to predict. That means that you're going to require a higher return on any investment in order to compensate for the higher risk due to the higher volatility, or you could also say less predictability. So what a market's like is knowns, not unknowns. So they want everything to be nice and stable, and that's going to make the risk drive down the risk. Okay, so just make sure that you put in the right values here on the right, and you should get the right required rate of return for your investment in this purpley box right here. And that's problem 711.